Purushottam, can you hear me? Purushottam, can you hear me?
Yes, sir.
Okay. Purushottam, please mute yourself. Purushottam, please mute yourself.
Yes, sir. Okay, sir.
See, today we have to start interest calculations in the general ledger accounting. We have to start interest calculations in the general ledger accounting. See, interest calculations. So, what is the function of these interest calculations and why we calculate interest on general ledger? In the general ledger, we have to calculate interest on GL account balances, like what? Term loans, working capital loan accounts, or OCC accounts, or overdraft accounts. So these are the GL accounts on which we have to calculate interest. Purushottam, I hope you can hear me, right? The class was started now. So, for example, we have taken one term loan, let us say for 20 years. And the term loan is to be repaid in the form of installments. And let us say we have to repay the installment on first of every month. So, before paying the installment, we have to calculate interest on the outstanding balance of the term loan as on the last day of the previous month, and the amount of interest has to be debited to interest account and it has to be credited to respect to term loan account, because your term loan installment amount contains two parts. Some amount is towards interest, some amount is towards the principal. So how much is the interest and how much is the principal in every term loan amount, in every term loan installment? That is also to be required. And also in the installment repayment, the interest portion has to be charged to profit and loss account. And if you don't calculate interest and if you don't debit the interest account and respect to credit the respect to term loan account, the balance of the term loan account in our books and the balance of the term loan account in the bank books relating to our account will not be matching. That's why before paying the installment on first of every month, for example, we have to calculate interest on the last day of the every month on the outstanding balance of the term loan, and that is to be debited interest account and it has to be credited to respect to term loan account. This activity is to be done on every term loan. Okay. Now you have the 50 term loans, and on every term loan the rate of interest is different. So with that situation, calculating interest on all the 50 term loans and posting 50 accounting entries is a little bit difficult task, and it's a time consuming task. Not difficult, it's a time consuming task. That's why SAP has developed some configuration settings. The FI consultant will configure these settings in the client company, and the accountant or the user who is responsible to calculate interest, he executes one program on the last day of every month or whenever he requires. Then the system calculates interest on all the 50 term loans and it will post all the 50 accounting entries. So in order to enable the system to calculate interest, the user goes to one transaction code, and in that transaction code, he enters the information in only 78 fields. That's it. Then the system automatically calculates the interest on all the 50 term loans. This is the interest calculation functionality. And if you see the first step, define interest calculation types. So what is this? So there are three types of interest calculations available in SAP. We can use only one or more of these interest calculation types. but we cannot define our own interest calculation types. What are the interest calculation types? Balance interest calculation, item interest calculation, and penalty interest calculation. And penalty interest calculation, right? So the balance interest calculation is denoted with the letter S in the system. The item interest calculation is denoted with the letter P in the system, and the penalty interest calculation is denoted with the Z in the system. And each interest calculation type is represented with one letter, and that letters also we cannot change. We cannot modify the existing interest calculation types, and we cannot create our own interest calculation types. We can configure one or all of these interest calculation types based on the client requirement. So the balance interest calculation type is used to calculate interest on GL account balances. Already explained you this. So GL account balances means term loans, working capital loans, overdraft accounts, etc. Then item interest calculation is used to calculate interest on vendor account and customer account balances. So why we have to calculate interest on vendor account and customer account balances? I'll give you an example. See, for example, we have one vendor, X vendor. X vendor account. So today we purchased material from this X vendor. Then we post the entry inventory of raw material accounted to vendor account. So that is posted to credit side. Buy raw material 10,000. At the time of supply, vendor said we have to make the payment in 1 month, exactly on 30th day. So if we make the payment after 30 days, for the delayed number of days, we have to pay interest. So unfortunately, we could not pay in time. So you have paid on 60th day. That is, we paid on 2 months. So how many number of days are delayed? 1 month. So for 1 month, we have paid interest. So along with the interest, the total amount you have paid is 11,000. So when you make the payment to vendor, the entry we post is X account or vendor account to bank. To bank account. Say 11,000 you have paid along with the interest. Now, you balance this account now. Today we are preparing P&L balance sheet and P&L account. So you balance this account. Credit side is 10,000, debit side is 11,000. Means there is excess debit of 1,000, which implies that you have to receive 1,000 in the personal account. Debit balance means we have to receive, right? So it shows that you have to receive 1,000 from the vendor. Is it really true? No. Then why you have paid this extra? Towards interest. That's why we have to calculate interest on this 10,000 for 1 month, and the entry is to be posted like this. Interest account data to vendor account. So by interest 1,000. Now you balance this. That is the reason why we have to calculate interest on the vendor account balances, and same is the reason to calculate interest in customer account balance also. So if the customer delays, you may have to charge interest. So interest on customer account balance is a revenue, and interest on vendor account balance is an expense. So if you want to calculate interest on vendor account balances and customer account balances, we have to use this type P. Then penalty interest calculation. This is used to calculate interest on interest. Means don't think that it is compound interest. Here interest on interest does not imply compound interest. Penalty interest means, for example, we have taken one working capital loan. So in the case of working capital loan, what happens? We have to pay the total amount of interest on all the balances we have used during the month on the last day of the month to the bank. For example, 31st October is there. So during the October, how much of the balance you have used from the bank towards your working capital? On that balance, you have to deposit interest as on 31st October to the bank. Unfortunately, this month we could not deposit that interest on 31st October to the bank. So you have deposited that interest on 10th November. In that case, according to bank norms, the bank will charge extra 1% or 2% on the amount of interest due. Suppose if the amount of interest you have to pay is 1 lakh, actually that has to be deposited on 31st October, but you have deposited on 10th November. So let us say 2% penalty interest is charged by the bank. That is 1 lakh 2,000 is to be deposited to the bank. This is called penalty interest. So in order to calculate penalty interest, we use this penalty interest calculation. In most of the cases, we use balance interest calculation and item interest calculation, the manufacturing concerns and the trading concerns. That is the first step. Define interest calculation types. Which type of interest calculation you are going to configure? That has to be defined, nothing else. Let us log into the system. See the path. SPRO, financial accounting, general ledger accounting, business transactions, bank account interest calculation global settings, define interest calculation types. Just 1 second. Click on new entries. Interest indicator is equal to, let us say, AA. You can give any identification. Just like that I have taken AA. Name is equal to 12% interest indicator. Name is equal to 12% interest indicator. Interest calculation type is equal to yes. Means if you press on F4, you can see the list of interest calculation types. P, item interest calculation, yes. Balance interest calculation, Z, penalty interest calculation. So I am selecting yes. If you select P, system gives the error message. Error message means you cannot use it for calculating interest on GL account balances. So compulsory we have to select yes because we are in the general ledger. Interest calculation type is equal to yes. Click on save. And Purushottam and Madhusudan, right? I will send you the server access, right, by today evening. Okay. Then you can start doing the practice. Now, what is this interest indicator? What is the function of this interest indicator? If you see the notes material, see all the 3 types of interest calculations I have given the explanation notes here. Then interest indicator. This is the identification for which we assign all the values necessary for calculating the interest. The interest indicator is assigned in the term loan account master record to enable the system to calculate interest according to the value specified in it. Means In order to calculate interest, we need some values. Like what? How frequently you want to calculate interest? Every month you want to calculate, or every 2 months you want to calculate, or every 3 months you want to calculate. That is called interval of calculation of interest. Then what is the rate of interest? Then how many number of days the system should take in each month to calculate interest? Whether it has to take 30 days uniformly or 31 days uniformly or actual days in every month like that. These are the values we require. These are the values we require to calculate interest, right? Now, at this point of time, you define one in identification, nothing else. It's just one identification. Later on, for this identification, we assign all these values. Then this interest indicator is assigned in the term loan account later on. Then the system calculates interest according to that values on the term loan account balance. So without interest indicator, it's not at all possible to calculate interest. That is the significance of interest indicator. Now, see the next step. Prepare account balance interest calculation. Path is same as above. See, prepare account balance interest calculation. First, let us do the step, then again I will explain. Click on new entries. Interest calculation indicator is equal to AA. This is what you have defined in the previous screen, right? Interest calculation indicator is equal to AA. Interest calculation frequency. How frequently you want to calculate interest? Whether every month or whether every 2 months or every quarter, like that. See, if you press on F4, right, or if you press on this button, see, if you want to calculate interest every month, you have to enter 01 there. If you have to calculate interest every 2 months, we enter 02 there. If you have to calculate interest every quarter, you enter 03. If the interest is to be calculated every half yearly, every 6 months, 06. If the interest is to be calculated every 1 year, we enter 12. How do we decide whether the interest is to be calculated every month or every quarter, every year? How do we decide? It depends upon the term loan agreement. So the term loan agreement clearly specifies that what is the interval of repayment of your term loan. If the repayment of the term loan is to be done every month, we have to calculate interest every month. If the installment is to be repaid every quarter, we have to calculate interest every quarter. If the interest is to be paid, if the installment is to be paid every year, we have to enter 12. So I hope everybody is following. So just like that, I'm using 01. Then calendar type. If you press on F4, these are the 4 calendars that are available. So what is the significance or what is the function of the calendar type? I will explain. First, let us take one calendar type, G. Calendar type is equal to G within brackets Gregorian calendar. Calendar type is equal to G within brackets Gregorian calendar. Then under output control, select balance plus interest. Select balance plus interest. Do one thing. Here you have select balance plus interest, right? Here itself, please write down. Right? Here itself, please write down. You put one arrow mark here like this. Then you write down like that. By selecting this indicator, the system will display the total amount of loan outstanding. The system will display the total amount of loan outstanding, including the interest, including the interest, as on the as on the date of interest calculation, as on the date of interest calculation. So here, okay, as on the date of interest calculation. See, suppose for example, interest outstanding is 1 lakh and the interest calculated is 1000. Then the system will display a single line showing that total amount of loan outstanding including interest is 1,10,000. This is just for the information of the end user. Suppose if you don't want this information, don't select this. But calendar type is compulsory. Click on save. So what is the significance of this calendar type? If you see the notes material again, calendar type. The calendar type determines the number of days to be considered for per period. Period means month. For each month, the calendar type determines the number of days to be considered for each period for which the interest is to be calculated. There are 4 types of calendars available for interest calculations in SAP. So we can use only one of these 4 calendar types. And also we cannot define our own calendar types. So here, these are the 4 calendar types available. B for bank calendar. Bank calendar. So bank calendar, if you use the bank calendar, what is the impact? It uses 30 days as the basis for the month and 360 days as the basis for the year. Means sorry, not this slide. Calendar types, it should be there. See, calendar types. Okay, it's not there. Just give me 1 minute. Just a moment. I'm taking it from another file. Yes. See, bank calendar. So I told you that it uses 30 days as the basis for the month and 360 days as the basis for the year. Means, suppose you have taken the term loan amount 1 lakh. Then rate of interest is 12%. This is the situation. Now, if you use the bank calendar, it uses 30 days as the basis for the month and 360 days as the basis for the year. Means, if you calculate interest for January, it calculates like this. 1 lakh into 12 by 100 into 30 by 360. Even though actually January contains 31 days. If you take the bank calendar, system considers only 30 days. And for the year, 360 days. Then If you calculate interest for February, 1 lakh into 12 by 100 into 30 by 360. Even though actually February contains 28 or 29, system takes uniformly 30 days. Similarly, if you calculate interest for April, 1 lakh into 12 by 100 into 30 by 360. Means whatever may be the month for which you are calculating interest, system uniformly takes 30 days for the month. And for the year, it takes 360 days. Here you have to assume that January is the example for the month containing 31 days. February is the unique month and April is the example for month containing 30 days. Clear? What is the impact if you use the bank calendar? First, let us try to understand the impact. Then we will see which calendar we use. Then, next one is J. J for Japanese calendar. Japanese calendar. J for Japanese calendar. It uses 30 days as the basis for the month and 360 days as the basis for the year. So the difference between bank calendar and Japanese calendar is only with reference to denominator. Numerator, same. Means if you calculate interest for the month of January, 1 lakh into 12 by 100 into 30 by 365, this fraction is taken by the system. And when you calculate interest for February, right, 1 lakh into 12 by 100 into 30 by 365. If you calculate interest for April, 1 lakh into 12 by 100 into 30 by 365. That is the impact. After that, you have third type of calendar, F, French calendar. So French calendar means it uses the actual number of days in a month as the basis for the month. It uses actual number of days in a month as the basis for the month and 360 days as the basis for the year. See, if you calculate interest for January, 1 lakh into 12 by 100 into 31 by 360. Because January actually contains 31 days, right? So 31 divided by 360. For the year, it takes 360. For the month, it takes actual days. If you calculate interest for February, 1 lakh into 12 by 100 into 28 by 360. And if you calculate interest for April, 1 lakh into 12 by 100 into 30 by 360. That is the impact if you take the French calendar. Finally, you have G calendar. G means Gregorian calendar. Actually, the calendar what we use in our daily life is called Gregorian calendar only. So, if you use the Gregorian calendar, it uses the actual number of days in a month as the basis for the month and 365 days as the basis for the year. Like this. If you calculate interest for January, 1 lakh into 12 by 100 into 31 by 365. If you calculate interest for February, 1 lakh into 12 by 100 into 28 by 365. If you calculate interest for April, 1 lakh into 12 by 100 and 30 by 365. That is the impact. So in our class, just like that I have taken Gregorian calendar. Generally, in the real time, we use bank calendar. That is the significance of calendar types. Now, define reference interest rate. Define reference interest rate. What is that? What is the reference interest rate? See, it is the identification for which we assign the real interest rate or the actual rate of interest. That is 12%, 13%, etc. The reference rate of interest is assigned to the interest indicator. Then we can define any number of reference rates of interest. Means, suppose you have taken 5 loans. On 2 loans, you are paying 10%. On another 2 loans, you are paying 11%. On the 5th loan, you are paying 12%. Now, for 10% interest, actual rate of interest, we define one identification that is called reference rate of interest. Then for 11%, you create another identification that is called reference rate of interest. For the 12%, we define one more interest in identification that is called reference rate of interest. So for each actual rate of interest, you maintain one identification. That identification is called reference rate of interest. So what is the use of this reference rate of interest and how these interest indicators are used? You can clearly understand after 2-3 steps. But at this point of time, let us define the reference rate of interest. Path is SPRO. Path is SPRO. Okay. Financial accounting, general ledger accounting, business transactions, bank account interest calculation, define reference interest rates. Click on new entries. Click on new entries. Reference rate of interest is equal to, give some name, let us say P1. Give some name, it can be anything. Reference rate of interest is equal to P1. Long text is equal to 12% reference interest rate. Long text is equal to 12% reference interest rate. Short text. In your material, short text is there. It's not short text. It is description. Description. Please rectify that. It's not short text. It is description. Description is equal to 12% reference interest rate. 12% reference interest rate. Date from 1/1/2017. This rate is applicable from 1st January 2017. Currency USD. Currency USD. Click on save. So assuming that on some of the loans we are paying 12%. So I have defined one reference rate of interest. Again, let us assume on some of the term loans we are paying 11%. So for 11% also we have to define one more reference rate of interest in the same manner. It is, even though it is not there in the material, just to look at the screen I am showing you. You click on next entry button. Reference rate of interest B2. Then long text 11% reference rate of interest. Description 11% reference rate of interest. Date from 1/1/2017. Currency USD. Click on save. Suppose on some of the term loans you are paying 13%. Click on next entry button. Give some identification B3 for example, and you fill up the other fields. That's how we can go on defining any number of reference rates of interest. Please remember, for each actual rate of interest, you have to maintain one reference rate of interest. Now, see the next step. Define time dependent terms. So what is this? First I will explain this, then you can easily understand. For example, we have taken one term loan from State Bank of India. We have taken one term loan from State Bank of India. This term loan amount is 1 lakh. And this term loan you have taken on 1st January 2017. Let us assume every month installment is 10,000. And the installment is to be paid on 1st of every month. So on 1st February 2017, you have paid first installment. When you take the term loan, the entry posted is cash account or bank account data to term loan account. So by virtue of that entry, that is posted to credit side of the term loan account. So when you repay the term loan installment, the entry is term loan account data to cash at bank. Because of that entry, the term loan repayment is posted on the debit side. Now, assuming that these are only the two business transactions we have posted in the term loan account, I want to calculate interest up to 31st December 2017. After the first installment, we did not pay anything. That is the assumption. That is the assumption. Now, I want to calculate interest up to 31st December 2017. How do we calculate interest in this manner? I will explain. Here on 1/1/2017, you have taken 1 lakh, out of which you have paid 10,000 on 1st February. Means from, one second. See, from 1st January 2017 to 31st January 2017, that is for 1 month. How much amount of the bank we have used? 1 lakh, right? If anybody is getting confused, ask me again, I will explain. So from 1st January 2017 to 31st January 2017, we have used 1 lakh from the bank. So for 1 month, you have to pay interest on 1 lakh to the bank. So on 1 lakh for 1 month, 1 lakh into 1 by 12 means 1 month of 12 months into 12 by 100 rate of interest, which comes to $1,000. Now, on 1st February 2017, you have repaid 10,000. Then, after this, you did not pay any installment. Then, from 1st February to 31st December 2017, that is for 11 months, how much of the funds from the bank we have used? 90,000, right? That is for 11 months. February 1st to 31st December. That is for 11 months. So for 11 months, we have used 90,000 from the bank. So on 90,000 for 11 months, you have to pay interest. 90,000 into 11 by 12 into 12 by 100. 11 months of 12 months, which comes to 9,900. So the total amount of interest you have to pay is 10,900. Till now clear, I hope. This is how we calculate interest in the normal way. But SAP calculates interest in a different way. SAP calculates the interest separately on credit line items and separately on debit line items. Why? I will tell you. Here, term loan is very similar to bank account. Okay. So in the bank account, withdrawals are always credits. Deposits are always debits. When you deposit the money, you debit bank account, right? So debits are always deposits. When you draw money from the bank, you credit bank. So credits are always withdrawals. So in the bank account, credits are always withdrawals, debits are always deposits. In context of term loan, debits are always repayments. Now, on the withdrawals, we have to pay interest. Then, on the deposits, that is, on the repayments of the term loan, we have to get the interest. Means, SAP calculates the interest on separately on credit line items and debit line items, and the net interest is posted. Why? I will tell you. Based on this, on 1st January 2017, you have withdrawn 1 lakh, right? So from 1st January 2017 to 31st December 2017, we have to pay interest to the bank for 1 year. So for 1 lakh for 12 months, 1 lakh into 12 by 12 into 12 by 100, which comes to $12,000. So you have to pay $12,000 or 12,000 rupees, whatever it is, $12,000. This is the interest you have to pay. Means it is expense, no? Interest paid is expense, no? So expense means nominal accounts. According to nominal accounts, debit all expenses. That's why SAP calls this as debit interest. Debit interest means interest you have to pay. Then on 1st February 2017, you have repaid 10,000. Means you have deposited 10,000, that is posted to debit side of the term loan account. So on the deposits, we have to receive interest. Based on that, from 1st February 2017 to 31st December 2017, that is for 11 months, on 10,000, we have to receive interest. So on 10,000 for 11 months, 10,000 into 11 by 12 into 12 by 100, which comes to $1,100. This is the interest we have to receive. To receive means revenue. Revenue means nominal account. According to nominal accounting principle, credit all revenues. So SAP calls this as credit interest. See how much logic they have followed in developing the software. Now, you have to pay 12,000. You have to receive 1100. Net how much you have to pay? Same, 10,900. There is no any difference in the amount of interest to be paid, but the way of calculation is different. Because why SAP calculates interest separately on credit items, separately on debit items? I will tell you. See, on the withdrawals, we have to pay interest to the bank, and we have to on the repayments we get the interest. While calculating interest, bank follows the same way. On the withdrawals, bank charges the interest. On the repayments, bank gives the interest to us. Generally, interest to be charged on withdrawals, interest to be allowed on repayments is same generally. But sometimes we don't know because this is the international ERP, right? So you may be going to different countries on the implementation. So in that country, you don't know what is the procedure, right? In some countries, let us assume on the withdrawals, banks are charging 12%, but on the repayments, they are giving only 11%. In that case, there should be facility to use separate rate of interest on credit items and debit items, no? That's why SAP calculates the interest separately on credit items and debit items, and the net interest is posted. Clear? So, for this debit interest, rate of interest is 12%. Then, for this debit interest, means on the credit items, you apply 12%. That is reference rate of interest B1. Then, on the credit interest, that is on interest on debit items, we use 11%. That is 11% means reference rate of interest B2. And these rates of interest may be changing from period to period. So the validity of each interest rate is applicable from which period to which period? It depends upon the time. That's why SAP calls this as time dependent terms, nothing else. That time dependent terms I am going to define now. So path is same as above. See, click on new entries. Interest indicator is equal to AA. Currency USD. Effective from 1/1/2017. Sequential number 01 means first term. Term is equal to credit interest balance interest calculation. Term is equal to credit interest balance interest calculation. Within brackets, select from F4. If you type manually, system cannot recognize it, and at the time of calculation of interest, it gives the error message. Term is equal to credit interest balance interest calculation. Within brackets, select from F4. Reference rate of interest is equal to B1. So credit interest balance interest calculation means debit line items. For the debit line items of the term loan, system will apply B1. Click on save. Then click on next entry button. Interest calculation indicator is equal to AA. Currency USD. Effective from 1/1/2017. Sequential number 02. Term is equal to select debit interest balance interest calculation. Select debit interest balance interest calculation. One second. Yeah. Debit interest balance interest calculation. within brackets, select from F4. Reference rate of interest B1. Suppose if you want to use another rate of interest, B2. But generally, as I said, on the debit items and credit items, use the same rate of interest. Okay, Purushottam. Click on save. Click on save. Now, in the case of working capital loans, the interest is calculated on day balances. In that case, for the debit items, you have to define 365 terms. For the credit items, you have to define 365 terms. So we can enter up to 3 characters here, 3 numbers here. Then enter interest values. This we will see in tomorrow's class. Akila, you have any questions? Okay. Anil? Okay. Chandrasekhar? Gadi? Okay, Chandrasekhar. Gadi? Himasaileja? Okay. Khalid? Okay. Madhusudan? Purushottam? Purushottam. Any questions in this class? Okay, good, Madhusudan. Purushottam, any questions from your side?
No, sir.
Okay. Roni? Okay. Srinivas?
No, sir.
Okay. Tafik? Okay. Teja? Okay, then see you tomorrow same time. Good night and good day.